Did you know that the world's most successful investors, like Warren Buffett, became billionaires by focusing on just one thing? Buying great companies at a discount. Sounds simple, right? Well, it's not. But here's the kicker: most people don't even know what they're missing. Over the last 40 years, value investing has outperformed the market by an average of 4% per year. That doesn't sound like much, but over time, those small gains compound into massive returns. Imagine if you invested $1,000 40 years ago and earned just 4% more than the market every year. You'd have over $21,000 today. That's the magic of value investing. In this series, we'll dive deep into the powerful strategies behind value investing. We'll show you how to find undervalued stocks, avoid common traps, and build a portfolio that grows year after year. By the end, you'll be equipped to make smarter, more confident investment decisions. Ready to unlock the secrets of investing like a pro? Let's get started. Chapter 1. The Treasure Hunt. Finding hidden gems. Finding undervalued companies is like a treasure hunt. You're searching for diamonds buried beneath market noise. But how do you spot them? Start by looking for companies with a low price-to-earnings (P/E) ratio compared to their industry average. Warren Buffett calls this finding businesses selling for less than they're worth. The trick is, it's not always obvious. A low P/E might mean a company is in trouble, or it could mean the market overlooked a golden opportunity. Check the price-to-book (P/B) ratio, especially for asset-heavy industries like real estate or manufacturing. According to Benjamin Graham, author of The Intelligent Investor, a stock is not just a ticker symbol, it's a piece of a business. If a company's stock is trading for less than its tangible assets, that's your signal to dig deeper. Look beyond numbers too. Insider buying activity is a little-known but powerful indicator. When company executives are buying shares, it often signals confidence in future growth. Studies have shown that insider buying can outperform the market by 7% annually. Finally, don't just stick to big names. Small-cap stocks often get overlooked, but they can be goldmines for value hunters. These companies usually lack Wall Street coverage, meaning fewer eyes are on their real worth. Chapter 2. The Patience Playbook. Mastering the long game. Value investing isn't for sprinters, it's a marathon. Patience isn't just a virtue, it's the foundation of success. Markets may take months, or even years, to recognize a company's real value. Did you know Buffett held Coca-Cola stock for over 30 years? His returns on that single investment are legendary. The stock market is a device for transferring money from the impatient to the patient, he once said. The lesson? Buy quality businesses and give them time to grow. But patience isn't passive. Monitor your investments regularly, but don't obsess over daily price swings. Instead, focus on the intrinsic value of the business. Use discounted cash flow (DCF) analysis to estimate what the company is truly worth, not just what the market thinks today. Market crashes can actually work in your favor. According to a study by the University of California, investors who bought during market downturns earned 22% higher annual returns compared to those who didn't. The key is staying calm when others panic. Lastly, keep emotions in check. Fear and greed are your biggest enemies. A journal can help you track decisions and avoid impulsive mistakes. Write down why you bought a stock and under what conditions you'd sell. This helps you stick to your game plan. Chapter 3. The Moat Matrix. Protecting your investments. Not all companies are created equal. Some have economic moats, unique advantages that keep competitors at bay. This concept, popularized by Buffett, is crucial for value investors. Start by identifying a company's pricing power. Does it have the ability to raise prices without losing customers? Think of brands like Apple or Nike. Customers stick around even when prices go up, which signals a strong moat. Next, look for network effects. Companies like Visa or Microsoft thrive because their value grows as more people use them. This creates a self-reinforcing cycle that's hard for competitors to break. Pay attention to cost advantages too. Walmart, for example, dominates because its scale lets it offer lower prices than rivals. If a company can consistently produce goods cheaper than competitors, it's likely to keep winning. A less obvious moat is intangible assets like patents, trademarks, or strong brand loyalty. Coca-Cola's recipe and global recognition are assets competitors simply can't replicate. According to a Harvard Business Review study, brands with strong intangible assets trade at a 25% premium. Finally, check if the moat is sustainable. Look at trends in the industry. Is technology changing the game? If so, even the strongest moat can erode over time. Stick to businesses that adapt and innovate. If you're finding these strategies useful, don't forget to hit subscribe. More great content on value investing and building wealth is just around the corner. Chapter 4. The Risk Radar. Avoiding value traps. Sometimes, a stock looks cheap but comes with hidden risks. These are called value traps. Avoiding them is crucial for protecting your capital. The first step is understanding why a stock is cheap. Is the market overreacting, or is there a fundamental issue? A low price-to-earnings (P/E) ratio might seem attractive, but it could signal declining earnings. For example, companies in shrinking industries, like coal, often trade at low valuations because their future growth is limited. Always check the debt-to-equity ratio. High debt can sink even profitable companies when interest rates rise. According to a 2022 McKinsey study, companies with debt-to-equity ratios above 2.0 had a 40% higher chance of bankruptcy during economic downturns. Look out for declining return on equity, ROE. A consistently dropping ROE can mean management is struggling to generate returns. Peter Lynch, author of One Up on Wall Street, warned, deteriorating fundamentals rarely reverse. Another red flag is dividend traps. Some companies lure investors with high dividend yields, but if those payouts exceed earnings, they're unsustainable. A 2021 Fidelity report found that over 60% of companies with unsustainable dividends cut payouts within 2 years. Finally, don't fall for hype cycles. Stocks in hot sectors often become value traps when investor optimism fades. Remember the dot-com bubble? Many cheap tech stocks in the early 2000s never recovered. Stick to businesses with real earnings and durable advantages. Chapter 5. Beyond the balance sheet. Digging into business DNA. Numbers tell a story, but they don't tell the whole story. To be a great value investor, you need to look beyond financial statements and understand the company's DNA. Start by analyzing management quality. Read shareholder letters to understand leadership's vision. Do they talk about long-term growth or just short-term profits? Buffett says, "I like to invest in businesses run by people I like, trust, and admire. Study the company's culture." A strong, adaptable culture often leads to long-term success. Netflix, for example, has a culture of innovation, which helped it transition from DVDs to streaming. Harvard Business School research shows that companies with adaptive cultures outperform their peers by 15% annually. Another overlooked factor is employee satisfaction. Sites like Glassdoor can give you insights into how employees feel about their company. Happy employees often lead to better customer experiences and higher productivity. Check the industry's future outlook. Is the company positioned for growth? A 2023 PwC report found that companies in fast-growing industries outperform the S&P 500 by an average of 5% annually. Finally, listen to earnings calls. These are goldmines for insights into how a company plans to tackle challenges. Pay attention to how executives handle tough questions. Transparency is a sign of confidence, while vague answers might signal trouble. Chapter 6. Building the Ark. Designing a bulletproof portfolio. A great portfolio isn't just about picking stocks, it's about balance and protection. Let's build a portfolio that weathers storms and grows steadily. Start with diversification. Don't put all your eggs in one basket. Spread your investments across sectors, geographies, and even asset types. A study by Vanguard found that diversified portfolios reduce risk by 40% compared to concentrated ones. Decide on your core versus satellite strategy. Your core should be stable, long-term holdings like blue-chip stocks. Satellites can be smaller, higher growth opportunities. This approach combines stability with upside potential. Allocate based on your risk tolerance. If you're younger, you might lean toward equities. If you're nearing retirement, increase your allocation to bonds or dividend-paying stocks. Fidelity recommends the 110 minus your age rule. Subtract your age from 110 to find your ideal equity percentage. Rebalance your portfolio annually. Markets shift, and your asset allocation can drift over time. Rebalancing helps you stick to your original strategy. A 2021 Morningstar report found that rebalanced portfolios outperformed static ones by 1.5% annually. Finally, always keep some cash on hand. Opportunities often arise during market downturns, but you can't take advantage if you're fully invested. Buffett famously said, "Cash is to a business as oxygen is to an individual. Never thought about when it is present, the only thing in mind when it is absent." If you found these strategies helpful, make sure to subscribe for more tips and tricks on value investing and wealth building. This is just the beginning of your investing journey.